Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, their relevance and impact. I'm Govindraj, Ethiraj. The central bank, the Reserve Bank of India, did not change interest rates this week, but however it increased the statutory liquidity ratio by 0.5%, which will infuse an additional 40,000 crore rupees into the system. The SLR is that part of deposits that banks are required to set aside and cannot use for lending. Reserve Bank of India Governor Raghuram Rajan, who has kept rates unchanged for the third time in a row, said there are upside risks to inflation in view of an uncertain monsoon and its impact on food production as also international oil prices. Repo rate, the rate at which banks borrow from the Reserve Bank, will continue to stand at 8%. The reverse repo rate, the rate at which banks park their surplus funds at the Reserve Bank, remains at 7% and the cash reserve ratio at 4%. The bank rate would remain at 9%.
I think the best time to do these cuts is when credit is not, credit demand is not so strong that the cut suddenly converts into a substantial increase in credit demand and a substantial shift away from government bonds. In fact, as many have said, the banks today have surplus SLR. So we think this is more about planning rather than about immediate effects, and therefore I would not anticipate large effects in the market today, but I think it would help the market going forward. Now
to discuss this, I'm joined by two economists, Madan, Sabnavis, Chief Economist at CARE, Brinda, Jagirdar, Independent Economist and former Chief Economist of the State Bank of India. Thank you very much for joining us. So Brinda, let me begin with you. No change in interest rates in itself is something that is sending a lesson, that is sending a signal of sorts. How do you interpret it?
I think increasingly what Dr. Rajan has done, he has said that my policy is going to be dependent on the data that comes out. So policy has become more transparent and more data dependent. He continues to say that I am focused on inflation, but I am also concerned about growth. Yet when he gets space from softening in inflation, from a consolidation on the fiscal side, from some comfort on the current account side, then he says I will have space to move around and cut the rates because he is concerned about growth.
So what is the headline takeaway, Madan, from the fact that interest rates remain unchanged and also on the fact that they've remained unchanged for a while and the last time that anything happened they were raised?
No, in fact, Govind, if you look at it, I think we've had a problem of inflation now for over 2 years. And I think there's been a debate earlier about whether monetary policy can actually bring down inflation or not. And I think now it's quite firm that the kind of inflation which we have in the country cannot be brought down by monetary policy. So therefore, monetary policy today is more a reaction to what's happening to inflation rather than a cure for inflation. So now the way we've looked at it is that on account of high inflation, we have seen that the purchasing power has come down substantially and therefore consumer demand has gotten affected and therefore we have seen industrial growth also slackening. So until we bring inflation down, I don't think we would be in a position to actually lower interest rates. Now, one of the negative repercussions of this phenomenon which we have had for so long has been that financial savings have been coming down and very simply put, we have negative real interest rates. So I think when the RBI now has made it very clear that they're going to target CPI inflation, I think it's very clear that as long as my real interest rates are negative, that is I look at my nominal interest rates, subtract inflation from that, and if I get a positive number, then probably we're on the right path. But as long as I have a negative number, I think interest rates will have to remain where they are. And we should forget about this whole kind of a traditional trade-off of saying that monetary policy is supposed to bring about growth or inflation or there's a trade-off. I think both of them go together. As long as we have high inflation, we will not be able to bring about growth.
Right. So, Brinda, what does this status quo mean? I mean, what does it really, what does it really tell us? I mean, because nothing seems to be changing and we're all on a wait and watch mode.
No, a lot is changing also. I'll come to that a little later. But first, that inflation needs to come down substantially and remain on a downward trend. What we are seeing
What's a comfortable number according to you?
Well, the RBI is targeting about 8% by Jan 2015 and 6% thereafter. So I think that's in the right lines. What the governor is saying is he's looking at the glide path. We are seeing a softening. We have seen a softening in CPI inflation, but a lot of it is also because of the base effect, which will be there till about say October, November. But there
is a deceleration.
There is, but then look at the vegetable and fruit prices. For example, during the same period, in the last 2-3 years from FY11, there has been an increase about 20% month on month. But now there's been a sudden acceleration, more than about 30-35% month on month increase in fruits and vegetable prices. So we need to make sure that this doesn't spill over and become a generalized inflation, doesn't spill over into the core sector.
Right. Okay. So what else is a situation like this sort of having an impact on? What is the sort of amplification of?
No, I think it's just that the market has been expecting just before a policy. The market always says that believes that the interest rates are going to come down, and when they don't come down, then just a few days before the policy, there's fair amount of volatility. You look at the money market, you look at the forex market, you look at the stock market, and once we get to know, 10 minutes after the policy is announced, you think they're going back to the status quo. So I think the market also needs to understand that things are not going to change, and RBI has made it fairly transparent that they have the Urjit Patel committee to go by. Now, whether or not we could debate on it, whether it's the right goal or not, but we have the 8% number, and until the RBI is convinced that we come below 8%, and it's going to be sustained below 8%.
Madan, let me put the first question in a little slightly differently. When a reserve bank or a central bank does not change interest rates, as it's not at this point of time, does it reflect control of the situation or a lack of control of the situation?
No, I think it's a combination of both. It's a case of saying that, look, I can't control inflation because it's on the cost side. In fact, just to deviate a little bit, I think when the RBI talks of saying that the fiscal deficit is responsible for inflation, I wouldn't go along with that thought. Because today, if you see, the inflation is coming purely on the food side, over which I don't think anybody borrows money in India to buy food products. And in fact, even when we use our debit card, credit cards, we always pay on time. So I don't think we're really affected by it. So I think it's more a case of saying that I'm going to wait for the extraneous conditions to make sure that inflation comes down, and then I'm going to react positively towards it.
Okay. So 40,000 crore more in the system, not the first time. What does that impact, and can that have any impact on liquidity and so on?
Certainly, it has an impact on liquidity in the sense it's giving banks a greater leeway. See, right now, banks are over-invested in the SLR, of course, something like about 28-29%. So the immediate impact is going to be muted. But here, this is for the future. Here onwards, when credit picks up and when the economy picks up and credit demand picks up, that's when banks will be more comfortable. But immediately, it infuses more liquidity into the bond market, into the money market. So I think that's again a very big positive. So Reserve Bank, let us not look only at the rates, through the limited prism of only rates, because Reserve Bank is also managing liquidity. At the same time, it is taking steps for banking sector reforms. So I think it's a huge policy that he's doing. And it's a combination of a lot of
elements. So two more points I want to come to. So one is the common man, and how should this be interpreted by the common man for future, and we'll come to that in a moment. What about the external sector, and what about growth, Madan?
As far as looking at the external sector, I think the policy has nothing to do with the external sector. That external sector is going to be driven largely by extraneous conditions. What happens on the trade deficit side, what happens to invisibles, what happens to capital flows. And I think the RBI has also mentioned very clearly that they're not really combining the two things, and monetary policy action is not presently being targeted at the external sector. So external conditions is going to carry on whatever happens on these fronts.
Right. And what about the impact on the common man? Let's talk about that.
So as far as the common man is concerned, I think if you're a borrower, like if you've taken a home loan or something of that sort, I think the expectation was that interest rates are going to come down, and that's going to be beneficial for homeowners. That obviously you will have to wait for some time. So I think even today, I think since the signal has been given, I think if you've already bought a house or you're planning to buy a house and take a loan, one needs to just look at how the inflation numbers turn out and see the trend they're moving in, and accordingly take a call on it. But I don't think the interest rates are going to come down until inflation number.
So therefore, would you agree, Brinda? Don't tie any decision which is to do with purchase or spend to interest rate or the interest rate environment.
No, I think that is an all-time advice. It's not just for now. Okay. So, but yes, at the same time, we can't expect softening in interest rates immediately. A whole lot will depend on how inflation pans out. But your question on the external sector, because this is a time when the
growth, I missed that. I'll come back on growth.
So the QE impact is we now have to wait, because it will start playing out now when the tapering ends sometime in October. So here on, we need to be a little watchful and see what will happen. Today's data, of course, today's information tells us that ECB has kept rates on hold. But here onwards, how the US economy, how the Fed moves and how the ECB moves is going to be very important for us also. So I think it's a very cautious move to keep rates on hold at this juncture.
Right. Okay. So we've talked earlier about some of the headline indicators that change, particularly on industrial production and overall GDP numbers. How do we fuse these two, and what does that mean? Unchanged interest rates, somewhat positive growth environment, but we are not sure whether the numbers will continue. And our overall aspiration of India sort of returning to a higher growth percent, RBI itself talking about a 5 to 6% rate.
See, so far whatever we have seen, the positive growth impulses in the core sector or in terms of industrial production, to my mind is more on account of a low base effect. Okay, even in case you look at the breakup of your industrial production, I think there are certain segments which have done well. I mean, the basic goods have done well. A certain segment of your capital goods has done well, again because of a low base effect. It's certainly not a broad base. So I think it's fairly fortuitous conditions today that lots of indicators are looking very positive. The global economy has improved, the exports are increasing, industrial production has picked up, inflation is coming down again because of a high base effect, even though we have a monsoon fear and probably the prices could start going up again. So on the whole, I think the only reason why I feel that growth is going to pick up this year is that probably on the policy side, there's certain incremental things being done by the government, which will have a positive impact. Certain investments are probably taking off. The government is quite keen that when it's committed to certain capital expenditure, that's probably going to be implemented in this particular year. So therefore, these incremental changes are going to lead to an improvement in GDP growth rate. But no big bang kind of a change. We're actually talking of 4.7, just about crossing 5%. Which is a recovery definitely, and I think in 2 years when nothing really took place in the economy, we managed 4.5, 4.7. So today I say that if something is happening, we could probably bet for something above 5%.
Right, and you mentioned the M word, right? Monsoons. We are now in the second week of August. How does that look when you look back at what we've gained or not gained so far, Brinda?
We've had a mix of a lot of fortuitous conditions, and one of them is the monsoon. We were looking at something like more than a 40% deficit, and today it seems to be under 20%. So to that extent there is an improvement, but let us not forget that the sowing has been less. The area under crops has been less than what it was at the same time last year. Let us hope that there is an improvement here, especially pulses, oilseeds. These otherwise would add to the inflation worries. So on the monsoon front, it looks like, you know, let's keep our fingers crossed. Till it's too early to say anything.
Okay.
But on the industry side, I think we can definitely see an uptick. It's a combination of a pickup that was a low base effect which we've had because capital goods has been negative or flat for the last 2 years. And a mix of government policy which is really very keen on.
Give me an example.
Clearances of projects, for example, and the Delhi-Mumbai corridor getting revived, and you know, a lot of projects like this. So, but we need to see actual capex happening. There are many companies, also private companies, who have announced that they would be ready.
And all of this, when added to the fact that interest rates are steady, may provide a good environment.
Absolutely.
Last word, absolutely, on the overall takeaway from this time's credit policy, Madan.
See, actually, it's just a matter of case of continuity. I think that's what we're believing in. I think there's been earlier, you know, there used to always be a surprise element in every policy. But I think now he's
says the data will clearly speak.
Yeah, the data will speak, but I think the only thing which I wouldn't probably think will read too much into is the SLR cut. I think what Brinda was talking about, because to my mind, when you have excess SLR securities and banks are voluntarily holding on to higher securities because you have NPA problems, capital issues which come in. So I think it's more of to placate the market. You're saying, okay, I'm reducing the SLR, but on the whole, I don't think it's going to make much difference in terms of overall liquidity.
Okay, so we have to take a break on this, but we'll come back and we'll talk about the government's proposal to take FDI in railway infrastructure up to 100%. You're with Policy Watch. We'll be back. Raising foreign direct investment in defense, as well as opened up the railway infrastructure segment for FDI or foreign direct investment again. Now, the FDI ceiling in the sensitive defense sector has been hiked to 49% from the current 26%, with the condition that control in joint ventures for manufacturing of defense equipment will remain in Indian hands. The Stockholm International Peace Research Institute records India as the world's largest arms importer, buying up to 70% of its defense hardware from overseas. The move is aimed at boosting the domestic defense industry. The Union Cabinet also approved a 100% FDI in areas such as high-speed train systems, suburban corridors and dedicated freight line projects implemented in the PPP mode. To discuss this further, I am joined by two economists, Madan Sabnavis, Chief Economist of CARE, and Brinda Jagirdar, former Chief Economist at State Bank and an Indian economist, independent economist. Thank you so much for staying on. Okay, so first question, when we, let's look at railways first, because that's sort of critical to the overall infrastructure. To what extent, Madan, can we separate railway infrastructure from the rest of infrastructure as we know and discuss it today?
See, conventionally we never include railways when we talk of infrastructure. We normally think of roads, ports. I mean, that's where we normally go into. We don't really talk of railways. But if you look at the railway budget this year, I think there have been big bang reforms which have been announced. I mean, we have grand plans to bring our bullet trains, high-speed trains, increase the amount of railway lines, etc. And I'm quite sure that the government on its own will not be able to finance it. So logically, it makes it makes sense that we open up to FDI, and to make it attractive to FDI, you open up to 100%. So I think it's a very good step which has been taken by the government. Though I'm not quite sure about how much of funds are really going to flow in. But the thing is, if I throw in a bit of economic jargon, I'll say this is a Pareto optimal situation where we would probably be better off, and nobody will be worse off in case FDI comes in.
Okay, Brinda?
If you look at the railway budget this time, we've seen that the operating ratio has been consistently more than 90%, and it's only increasing, which means most of the revenue is going into current investment, and there is very little for actually capital development, capital investment, and developing the infrastructure. So it's high time that we looked at development of the infrastructure, which of course the current government is doing, particularly in railways, because railways also has a huge multiplier impact on industry and on services. I think after agriculture, perhaps railways is the largest provider of employment.
Right. So what I am trying to understand is what is the kind of kicker the overall infrastructure sector could get, assuming things were to move faster in railway infrastructure versus rest of infrastructure, which is roads mostly.
Roads, ports, and
so roads and ports. I'm saying, so assuming that stays at the same level it is today, or has picks up at its own pace, but railways were to really get a boost, what is the kind of slack transfer that could happen?
You know, it's difficult. I don't have a number to put on it, but what I would say is that there's a connectivity between the railways and the ports and the roads and the ports. So this connectivity is going to have a huge multiplier.
So you're saying the integrated impact will be much higher if we were to see more this thing. Madan?
There'll be a lot of backward linkages with various industries, because if you see what really goes into any of these sectors which you're talking of, it's going to affect the cement industry, it's going to affect the steel industry, the machinery industry. So I think there will be very strong backward linkages which will be forged in case we do have this kind of FDI coming in. But the whole question is that how much of FDI is really going to come in, because we should remember that we're only talking about the infrastructure which goes into railways. Operations of railways is going to remain largely in the hands, is going to continue to remain in the hands of the government. So to that extent, I don't know what will be the level of interest of foreign investors. So I don't expect big bang kind of...
What the government is saying is 3 or 4 areres, right? Electrification, signaling, special purpose vehicles for last mile connectivity, PPPs, suburban and high speed trains.
So it's only going into these kind of activities, not in terms of operations. That's the main point. Now, if I'm a foreign investor coming in here, ideally I would also like to know how the whole thing is how the whole thing is functioning. But that's going to be out of their own purview. So I only see strong links coming backwards to industry. There's going to be no negative effect as such. And the thing is that we require the funds, and if somebody is willing to provide it, that will be good for everyone.
And what are the benefits that one can that could arise assuming people came in, and what would be the challenges? I mean, you know, given our track record in managing infrastructure projects, including in PPP, what can we learn, or what are our lessons?
So the whole problem will be about the way in which these contracts are given. I mean, how are the people going to qualify? Are they going to be put any kind of conditions for being put for it? Like, just if I draw an analogy to FDI in retail, forget about whether the states are ideologically with it or not, not with it. But a kind of conditions which we have put, saying that if you want FDI to come in retail, you'll have to have certain kind of investments in the back end infrastructure. You need to procure from the SMEs. I think that's been a deterrent, and I don't think anybody's been interested in coming out here. So it depends upon the conditions, a kind of a map which we lay down, and the kind of facilities which we provide to these investors, which will actually decide upon how much money is going to come in.
And would it mostly come from sort of multilateral institutions and so on?
No, I'm actually looking at more at private players coming in and seeing an opportunity, because this would be something totally new for us and new for them when they're looking at India as an investment destination. So that's the way I look at it.
Right. Yeah.
I would say there are 2 big challenges in this whole thing. One, of course, is land acquisition, because we know.
I want to ask that actually.
Because we know that a lot of road projects have actually got stuck at the last mile because of not being able to acquire the land. So I think that would be one challenge. And the second challenge would perhaps be the interference, or let me put it this way, governance. So once we have some clarity on both these, then I think we would have people willing and ready to come and invest in India and invest in the sector.
But rail infrastructure in general is an area which requires some homework before we start.
Absolutely.
Because we've never done it in the past in the manner that is being proposed here.
I agree.
Right. So there's a lot of legislative changes. So if you were to tie this now with the theme of defense FDI, which is going from 26 to 49%, how does that appear to you?
I think it's very good. It appears. I mean, I think it's on the right lines. And because you give a little more leeway, people will want to come in and invest. It's more than 26%. So I think that's a very good thing. And just because the government remains a majority owner of railways, I don't think that is going to deter any foreign investor from coming in, because they are in like the areas that you rightly said, the whole lot of signaling, equipment, etc., etc. Similarly with defense, we are the largest importer of defense equipment. So I think on both these counts, this policy is very good, and my own sense is that this will give a big fillip to manufacturing sector in the country.
Right. So, Madan, how would you tie the 2 or 3 things in, right? The overall stance on liberalization and reform, opening up areas which are traditionally have been sort of...
See, I think railways is less controversial, but if you're looking at defense, I think it's definitely controversial. I would have preferred if you had gone beyond 49%. In defense, because I think that could be a deterrent. Of course, the fact that it's a big market, because India is the largest importer and one of the largest spenders on defense.
And there are so many Indian companies who want to
Indian companies, so I think that's the reason. But I don't know what kind of a pull factor will be there on account of 49%. But again, I would go back to what I said in the beginning, that any amount of money which comes here is always welcome for us, especially if it brings in along the technology which is required.
Right. So how does this look as a package now? I mean, which is what I'm trying to understand, right? So overall sort of liberalization continuing to open up, of course, opening up 100% in an area like railway infrastructure, which maybe we did not expect, defense, which we to some extent did expect, and then there's insurance. So how does this all add up to the India story?
No, it's quite clear that I think the government is very keen on sending the right signals to the market, especially to foreign investors, to say that we do stand for liberalization as far as FDI comes. But we're going to go in a particular manner. It's going to be in a calibrated manner. I think that's the new thing in Indian jargon, where we say everything is done in a calibrated manner. The low-hanging fruit is probably something like railways. Let's try and experiment and see what happens. And probably at some point of time, we could also be looking at insurance going beyond the 49% level, and maybe at some point of time even insurance. Retail.
Right. Okay. And Brinda, how do you see the combined thing, the package?
I think it's all. The government is looking at it in a very, very balanced manner. It all
you're seeing a path and continuity and all of that.
Absolutely, because all the objective is to make it easier to do business, to give more leeway to the private sector, and bring in entrepreneurship, technology, funds, revenue, capital. So I think it's tying up very well, and opening these sectors is very important, like I said, with the linkages that the sector has, with its implications for employment that there is. So altogether, I think overall, I think it's a very good package. The whole idea is to create an enabling environment and to put in place policies that make it easier to do business in India.
Okay, last word, Madan.
No, but I think given the fact that we still rank quite low when it comes to doing business, I think we need to do a lot of house cleaning to make sure that the money really comes in. So it's one thing to say that I'm opening up various sectors, I want a lot of dollars to come in, but one reason why we have been stuck in this region of $25 to $30 billion coming in is because doing business is difficult. I think some steps have been taken in terms of labor laws, which have tried to tweak and make it easier, but I think the government now needs to also focus a lot on that to make sure that the foreign funds do come in.
Right. So funds are likely to come in or will come in, but make sure that you create an overall enabling environment. And the path that both of you seem to agree is still in the right direction.
Yes.
Right. And of course the interest rate is benign or steady at this point of time.
Yeah, interest rate remains steady, and I think we're now used to the fact that we'll wait for those inflation numbers to come down, only then will.
And right, finally, for the common man who we touched upon very briefly, if you're going to buy something of a house or a car or whatever it is, or a two-wheeler, this really should not bother you, because you should be...
Yes, absolutely.
Yeah, right. That's a good note to end on. Thank you so much, and that's all we have time for this edition of Policy Watch. We'll be back next week, same time.